Hey, it's Vince Bart with the Victoria Property Specialist Group, Remax Camosun in Victoria. I'm here with Duncan Gardner from Great Pacific Mortgage. Hey, Duncan.
Hey Vince, how you doing today?
Pretty good, man. So we're
Awesome.
back at it with another video in the series, and today we're going to talk about, well, what are we going to talk about? We're going to talk about high ratio mortgages and how GDS impacts that. So what the heck is a high ratio mortgage?
Absolutely. So if you didn't catch the first video that we did about the different types of mortgages, go look at it. It'll kind of catch you up to speed as far as where we're at today. But for those of you who are maybe too lazy or just going to start today, we're going to talk about high ratio, also known as insured mortgages. Just to reiterate, an insured mortgage is a mortgage that has mortgage default insurance. This is an insurance premium that is paid for by the borrower to the benefit of the lender. Typically, this premium, which can range anywhere from sort of 2.5% all the way up to 4% of the funds advanced, gets tagged onto the mortgage. So sometimes people think that their mortgage is only going to be $500,000, but then you throw on the insurance premium and all of a sudden the mortgage is $520,000. It can be expensive, but it's also spread out over the course of the loan, and it really doesn't dramatically affect your monthly payments. So while it may sound scary to add that kind of cash to or that kind of an increase to your mortgage, don't worry about it. It's something that you have to do anyway, so there's no point in sweating it out. We talked about why it's mandated. So the government of Canada basically has come in and said, okay, any purchase that has less than 20% down has to have mortgage insurance, mortgage default insurance. And so they've also told these insurance providers that there are certain qualifying guidelines that have to be met. They're very strict about this. There's no wiggle room. When it comes to your GDS or your TDS calculation, you have to fit within the ratios. And if you can't, you can't. And that means you just can't borrow that much money.
Okay, so hang on. You said GDS ratio. What does that mean?
Yeah, so GDS is one of the two calculations that a lender is going to use to qualify you. GDS, also known as gross debt service ratio. This basically is a simple calculation that is going to compare your annual gross income or your combined annual gross income if you have two partners or two business partners going in on a house together. And it's going to compare them to the carrying costs of owning a home. And so those will be the total annual mortgage payments, including the principal and the interest you've paid, the property taxes that you will incur annually, the heating of your home, because you can't live in a house if it's not warm, and if you're buying a strata unit, it's also going to take into account 50% of your total annual strata fees.
So do you think that's why people's parents always tell them to keep the heat down, because they're trying to keep their GDS low when they try to qualify for a mortgage, or do you think that's unrelated?
I'm going to say unrelated, but I am the same type of person where my thermostat is constantly moved around to make sure that we're not having these astronomical hydro bills. So it's a good habit to be in, especially from a budgeting perspective. And hey, if you're going to have to save up to buy a house in Victoria or anywhere on the island, you're going to need every penny. So it's a good idea to get into the habit of watching your heat for sure. Now, the cool thing about the heat is most lenders aren't going to actually look at your actual heat bill. What they're going to do is they're going to apply a simple calculation that's going to compare the square footage to a certain dollar or cost per square foot, and then they'll use that for your calculation. It's actually quite low compared to what most people's annual heat is. So there's the good news.
Well, that's good. That's great. And so with that ratio, that is really just everything that's associated with owning that home for qualifying.
Yeah, exactly. Essentially, it's the carrying cost of being a homeowner.
Okay.
The very basics.
Gotcha.
And so, yeah, the when it comes to the insurer, the maximum that you can allocate to those carrying costs is 35% of your gross income Or if you have 680 plus credit score, 39%.
Okay. Interesting.
CMHC, which is one of the three insurers. There's CMHC, there's Genworth, which is now Sagen. They were purchased by Sagen, and Canada Guarantee are the three mortgage default insurers. CMHC recently came out and said they are not going to go to 39% regardless of what your credit score is. They are capped at 35%. The other two have not followed suit. So there's the good news is if you need that extra 4% of your gross income to go towards that, there are still two insurers that will do that provided you have a 680 plus beacon score.
Gotcha. Okay, that's very interesting. And so in our next videos, we're going to dive into a little more of those different ratios, and there are some other calculations, but really this all comes down to what is required to qualify for a mortgage.
Yep, absolutely. I think next time what we'll do is when we talked about that annual principal plus interest mortgage payment, there's a catch. You have to qualify based on the stress test. And so we're going to talk about the stress test in another video.
Sounds great. Looking forward to it.
Okay, thanks, Vince.
Thank you.